Okay, so we're going to talk about why you shouldn't invest like your dad. I'm going to bring some hard truths that your financial advisor, quite frankly, doesn't want you to hear, and I'm going to tell it to you anyway. So here's the deal. The way our dads were taught to invest worked well for most of them, but the world has dramatically changed. And with that change, I believe our thinking needs to change to match what the current environment is today, not what it used to be. What we took for granted as the right thing to do may not be the case anymore. So let's kind of dig into this a little bit. So I was talking to a close friend who told me that he was afraid of running out of money before he died. And this shocked me because he's in his 70s. He's a self-made billionaire. All of his investments were tied to what he was taught his entire life. You get a job, you invest, you put it into a 401k, get the stocks, get the bonds, and then you'll end up being okay. While traditional investments like this on the public market have been and will continue to be a great wealth creator, that's not what I'm talking about here. What I'm talking about is that when it comes to retirement and setting yourself up for a certain retirement, there's inherent complexity and volatility that I think needs to be considered when you invest it only into the public sector. So let's look into this a little bit. So traditionally, when recessions are looming, buying a company like AB InBev is a fantastic thing because beer sales typically go up, alcohol sales typically go up during a recession. People get a little depressed and they drink a little bit more. So AB InBev posted one social media post with an influencer, and that influencer sparked a $27.5 billion market valuation loss. And it was just one social media post that sparked it in 2023. So what's happening now is that there has never been a time of higher volatility in the public investing vehicles. 30 years ago, a social media post couldn't take down AB and had to lose $27.5 billion valuation. Social media wasn't even around, right? At the end of the day, the retirement problem is interesting because it's not necessarily a nest egg problem. It's actually a cash flow problem. So think about this. How do you know how much money you're going to need before you die? The only possible answer is that if you knew how long you were going to live, whether you're going to get sick or not, need advanced medical treatments or not, or if you avoid that and end up dying a quick death. Okay, so yeah, I'm getting a little bit morbid here. I didn't necessarily even think I was going to go there, but I suppose I'd rather bring the truth than try and sugarcoat things. So anyway, if you live to be 90, the millions you need saved is completely different than if you live to be 100, because we can't see the future. Focusing only on a nest egg for retirement creates a whole lot of stress and a whole lot of uncertainty. Adding to it, the volatility of these public markets and how recessions and wars and elections can impact people's public investments adds to the uncertainty as well. Having this as someone's only strategy is like having a house built on sand. Unfortunately, most financial advisors will bring you this truth because they've been programmed to believe that the world is a certain way, because that's how it used to be, right? And because financial advisors are incentivized to have you work as long as possible and put as much money as possible into their accounts. If you were to take some of your IRA money and some of the extra cash that you have available and invest it into real estate to get passive income, many will see this as competition because they will be losing income from you. Now, not all of the advisors out there will. There are many true fiduciaries out there that are really looking out for their clients' best interest. And so I don't want to throw everybody under the bus. There's definitely world-class advisors out there. So here's the cool thing, though. Let's think about this. Having passive income and that cash flow from your investments, that's something that replaces a job's income. It also creates a situation where the length of time you live doesn't end up mattering. So let's say it takes you $10,000 a month to live, and you have $10,000 a month of passive income coming in through your real estate investments. At this point, you can live to be 90, you can live to be 100. If the cash flow from your investments is covering your monthly expenses, you're good to go. What's worked for me and what's allowed me to call it quits and many of the people that we've worked with is real estate investing. I was first focused on building up my real estate portfolio and building cash flow from it. Once this was in place, what I was able to do is branch out into some of the other investments that are a little bit more traditional. I can now take risks on high upside investments as well. And if I lose all my money, it doesn't matter because I have a foundation in place of cash flow and of passive income from real estate. So I have a lot of great free resources available for you. If you're looking for a great way to get started and learn more about investing passively in real estate, check out jimmanning.com. And I have a free course. And the course is about generating passive income. Back in 2022, we were able to generate over $5 million in passive income that year alone. And anyway, there's a lot of great resources in this. I have my favorite 3 strategies. It took us about 3,000 deals for me to figure this out, but I have 3 favorite actually passive income strategies when it comes to investing into real estate, and I put those in that course as well. So check out the Generating Passive Income course. Okay, so that's it for the show. Thank you so much for tuning in.